In this video, I'm going to present how central banks use interest rates as a tool to direct the economy. Furthermore, I will describe the effects of this process. Up until now, we have seen that central banks are independent institutions and conduct monetary policy. But, as their name indicates, they still act like banks. So, lending money is part of their business. However, in comparison to commercial banks, they do not lend money to people or businesses. Instead, they are the ones who lend it to commercial banks. Here, like in every other lending-borrowing relationship, interest rates play an important role. We will discuss this role a bit later, but first, let us quickly remember the effects of the lending and borrowing processes on our economy. Here is an example. Imagine a person dreams about buying a horse. To buy it, he borrows money from a lender and buys a horse. Our horse dealer receives money which he can use to fulfill his own dreams, for example buying a car. For this he borrows more money to buy a fancy red car. But now the car dealer also dreams of buying a house, for which she needs to borrow more money. Where does this process lead us? As more borrowing brings more money into the economy, the money supply increases, more of it can be spent. What happens if the production and generation of wealth remains on the same level? Then there is more money than goods to be bought and their prices rise. We call that inflation. If the inflation becomes too large, the central bank must interfere by making borrowing more difficult and decreasing the money supply in the economy. But how? Central banks lend money to commercial banks at a certain interest called the discount rate. How do central banks use the discount rate to fight inflation? They raise the discount rate. That way, borrowing becomes more expensive for commercial banks who pass this increase by raising the interest rates to their customers, people and business. This affects the whole economy because, due to the increase in interest rates, borrowing becomes more expensive and unattractive. That's why many people will stop borrowing and therefore stop spending, resulting in less transactions and lower income for sellers of goods. To summarize, the increase in the discount rate leads us to a situation of less borrowing and spending. This can go on until there is less money than goods in the market, and accordingly, prices fall. This development is called deflation and represents the counterpart of inflation. To avoid that deflation gets out of hand, central banks must interfere again. And you guessed it, they interfere by decreasing the discount rate so commercial banks decrease the interest rates to their customers and borrowing becomes more attractive, which causes more spending, more transactions and greater income. All of this is part of economic development, which is characterized by periods of expansion and periods of recession. The maximum and minimum points of these periods are known as economic boom and economic depression. These ups and downs in the economy are related to the monetary policy that fluctuates from periods of increase of the discount rate, contractionary monetary policy, and periods of decrease in the discount rate, expansionary monetary policy. Sometimes the use of discount rates to guide the economy is not enough. For example, in times when the discount rates are already close to zero. In this case, central banks use other tools which I will introduce in the next video. So for now, thank you for your attention and see you next time.